Can we get the housekeeping comments, please?
Good morning.
Thank you for participating in today's meeting. Please do not connect to Zoom or teleconference while in the room, and please silence all devices. Click on the globe at the bottom of your screen to select either English or Spanish. Public comment will be taken after each item. If you are in the auditorium and wish to comment, please use the iPads located in the lobby. For meetings in other locations, please complete a blue speaker card and provide it to a South Coast AQMD employee. Speakers may be limited to a total of 3 minutes or less for all agenda items, and times may be shortened to ensure all speakers can be heard. A countdown timer will be displayed on the screen for each public comment. More time will be allotted for Spanish translation that is not simultaneous. For questions or issues on public comment, please call the public advisor at 909-396-3247. That's 909-396-3247. Please adhere to the speaker time limit and treat others with courtesy, civility, and respect. Failure to do so can result in your mic being muted or you being removed from the meeting. Be aware that this meeting is being recorded. By participating, you are authorizing recording of audio and visual content presented during the live event and consent to subsequent use of the recording in the public domain by South Coast AQMD.
Well, good morning, everyone. I'd like to welcome everybody to the South Coast AQMD Hybrid Investment Oversight Committee meeting. It's Friday, September 13th, 2024, 8:02. I'd like to call this meeting officially to order. I'll have a roll call by Jenny Pierce. Jenny, go ahead, please.
Supervisor Hagman, absent. Board Member Padilla-Campos. Mayor Salache. Mr. Dixon.
Good morning. We're present.
Jill Wynot.
Here.
Chair Cacchiotti.
Here.
3 present, 1 absent. 2.
That's a quorum, correct?
Sorry, correct. 3 is a quorum.
Thank you. Again, welcome everyone, our great staff who's here, the public, online, our consultants, and our committee members. Let's go to our first item on the agenda, and that would be our quarterly report of investments by Sujata Jain, our Chief Financial Officer.
Good morning, Chair Cacchiotti and members of the committee. Sujata Jain, Chief Financial Officer. This item is to report the cash balance in the LA County pool surplus and special purpose investments as of the second quarter that ended on June 30, 2024. The balance was $1,598,246,566. The composition of our investments are 90% in LA County pool surplus and 10% in special purpose investments. The earning rate for June 2024 was 4.25%. And with that, I'll be happy to answer any questions.
Committee members, any questions for Sujata?
No, it was a very good report.
Richard, thank you. Thanks, Jill. No question. I just have one quick one, Sujata. You know, I always ask you on our treasury bills and the treasury notes, I guess, on page 3 and 4 that are maturing, I guess, in November, December.
Yes.
What are your thoughts, you and Richard, as you, or with the LA County pool, as you, in a few months, look to reinvest those, or what are you thinking?
Yes, so thank you for that question, Chair. I did look at that. I did reach out to LA County earlier this week, and the rates will be going down. So my thought is I will reach out to our staff over here for the restricted funds to see if, we can start investing now. And those, when they will mature, they'll just go back into the pool. So that we can, lock in some little bit higher yield. And what I was quoted was that it could be a 1 year that could give about 4% right now. So I just need to know that can I lock in the same amount that's maturing? Because if it's like about, say, 30, 40 million in a particular fund, could we invest another 30, 40 if there's no, cash need in this period of October, November, December?
So if I count those right, is that 40, 80, 120, $130 million are maturing with it in November, December?
Correct. And some of it is a general fund, which I am a little bit worried about investing that much. So, because, that's our operating fund.
Right.
So to take that much out of cash and lock it in. So I'll look into that one a little bit. I did it as of June, invest at least 10 million more out of the general fund
Great.
to make it a little bit more. And we got a very good rate. It was 5.34%.
No, that's great. I think I like your strategy, anticipating and really looking forward. Great work.
Thank you.
Committee members, any more questions on that item? Is there any public comment on this item? I see no hands raised from the public. Nobody in the auditorium looking around. Great. So we'll move on to item number 2, our financial market update. Richard Babb, with Senior Managing Consultant, PFM Asset Management. Richard, welcome.
Thank you, Chair and committee members. It's a very interesting time right now. I'm not seeing the presentation on my screen. I just want to make sure that it is that people can see it.
They can.
Okay, perfect. So this report, a lot of it is from the second quarter, which was sort of a middling quarter in the sense that inflation was moderating. We still had a strong job market. The Fed was on hold. Expectations from the Fed were that they would cut interest rates by 25 basis points or 1/4% during 2024. In the third quarter, we've seen significant developments in the sense, starting with the July employment situation report, that inflation continues to moderate, but we've seen significant weakness or shifting in the labor market. It's not as strong. The market's sort of saying, well, maybe the Fed's waited too long. They're going to have to act aggressively. So it will be really interesting to see how the Fed reacts next week at its open market committee, where it'll a couple things. One, expected to cut interest rates, but it's not sure if it's 25 or 50 basis points. It'll also be a time where they update their economic projections for 2024, which will give an indication of what they think will be happening. So if I go to the next slide, or the first slide, it's showing US GDP contributors and detractors. The key story from this is that GDP overall has remained favorable. This was showing that second quarter GDP was at 2.8%. It was actually revised upwards to 3% on slightly stronger consumer spending during the quarter. And the Atlanta Fed's current estimate of third quarter GDP, again, it's a running estimate which is affected by each economic release, is about 2.5%. And it's been in that 2 to 2.5% for most of the quarter. So overall, the economy is growing above trend. So the Fed expected GDP to grow in at about 2.1% in their June forecast. So from that standpoint, to date, the economy is growing pretty good. If we go to the next slide, where we see CPI continues, this was a 2.9% number as of July. The August number came down even lower at 2.5%. Core was higher when you take out food and energy, especially the energy component at 3.2%. But what we're seeing is the overall trend tends to be where the Fed wants to be, getting back to that 2% number. One thing that's really important at this level is that we're seeing a lot of base effects, that sometimes what's happened is we'll have a low inflation number month over month at the beginning of the 12 months. As the next month comes in, even if it comes in at 2%, if you drop off that low number, it can drive it up a little bit. So we're seeing some of that happening. Overall inflation numbers remain favorable and going to the Fed direction. So that's why people feel that the Fed is free to act given where labor is. If we go to the next slide, which is inflation moderates, continues, the key sort of things that I want to have on the left-hand side is showing you the major components. And the key story is, while inflation on a year-over-year or month-over-month number is definitely moderating and in becoming more to the Fed's level, the overall embedded inflation is up significantly. So for most of my clients, when they're talking about their budgets, doing labor negotiations with their bargaining units, all of these factors, that they're having to account that prices many times are 20 to 50% up, depending on what you're talking about. If I go to the chart on the right, what's interesting is in the July report, it showed energy coming in at 1.1%, 12 months over on the 12-month change. In this latest number for August, it was a 12-month decline of 4%. Energy tends to be somewhat volatile. A lot of the numbers were basically unchanged, slightly lower in most cases. So that's why overall CPI came in lower for the August number than July. But again, the overall story is good. If we go to the next slide, which is PCE inflation. So on this chart, what I'm showing you is the month-over-month inflationary numbers. And what we see on this is that dotted line is the 2% target if we annualized it for a month-to-month over number. If I took this to the July numbers, which have came out, which is the latest number that the Fed will see prior to next week's Fed meeting, is that the CPI numbers were unchanged. The month-over-month numbers came in at 0.2% for both core and headline, which was favorable. But one thing that sort of offset that, like I was talking about, this base effects, if you look to the far left of the chart, that you had the July 2023 numbers for both of those at 0.1%. So those dropped off, and the new number, while not inflationary, didn't in a sense bring things down because of that change. If we go to the next slide, producer prices rose. So in June numbers did rise. What we've seen is if I brought this up to August, they were 1.7 versus 2.6% in June. So generally, prices are becoming more stable that we're seeing. There's certain elements that are good, but again, I think the overall story from an inflationary standpoint is favorable. If we go to the next slide, jobs market slows as it comes into balance. This is where the big economic driver has been. So inflation definitely moderating, still above the 2% target, but the labor market had been very strong for most of the year. But we've seen changes that it's weakened, not fallen off a cliff, but it's definitely come down. So the June number came in at 114,000 when 165,000 was expected. And that sort of was a big shift in market expectations. They said the economy is slowing, the Fed has to act aggressively, may even do a pre-meeting cut. I think it was good that the Fed didn't do it, but it was a resetting of market expectations. And the data that we've seen since then hasn't necessarily been better. We saw that the 12-month numbers were revised downward by 818,000. Each year, the Bureau of Labor Statistics revise the numbers as they get more complete and accurate data on all of this. So it's normal, but the 818,000 number was higher than expected. We saw that the August numbers come in at 142,000, which was an increase over what we saw the prior month, but below expectations. And what was somewhat disconcerting is the prior 2 months were revised down by 86,000 jobs. So that June number, which was disappointing at 114,000, was revised downwards to 89,000. So again, the labor market we're seeing weakening. The job openings versus unemployed number, which is the JOLTS report, the ratio of jobs available versus each unemployed person was about 1.2 on this when we saw it in the June number. In the latest number, it's 1.07. So again, we're seeing softness on that. The Fed would like to see it about 1.1, 1 to 1 in a sense, that one job available for each unemployed person. So they like that because it puts downward inflationary pressures on the job market. And if we go to the next slide, what we see is the unemployment rate for this ticked up in the July numbers. In the latest numbers that we got, it ticked down for the United States. It went from 4.3 to 4.2. The Fed was expecting it to end the year at about 4.1. But we see that the story isn't uniform, that the unemployment rate in the Riverside, San Bernardino, Ontario area was 5.8%. It's not a seasonally adjusted number, so you'll see more volatility, but in general, you see it higher. And the unemployment rate in California for the latest number was 5.2%. So again, there is some concerns about that. looking forward, if we go to the consumers driving the economy and how do they feel, we've actually got good news. So on the next slide where it says consumer sentiment, that the latest number that we've got is ticked up about it's at 69 now, which is 1.8% year over year increase. The other aspect of it is we look at the change in prices during the year. We've got one more data point that just came out, and that the expectations for inflation over the next year is about 2.7%, which is sort of in line pre-pandemic. So people are seeing that inflation on a going forward basis is coming more in line, which makes people less concerned about the economy, more feeling that they can spend. There are things we are concerned about the consumer. So while the overall economy looks good, we're seeing weakness in the labor market, we are seeing weaknesses in certain areas that does rise concern. So on the slide that says consumer health, the chart on the left shows you the delinquency rates on all consumer loans as issued by banks. And what we've seen is that the delinquency rate in the latest number has come up to 2.74%, which is slightly above the 20-year average. So you're seeing, and it's been increasing. So again, people, especially on the lower economic ends of the economy, are becoming more stressed. And then the chart on the right is personal savings rate. It was 3.4 number in the number that was available when this chart was produced. It's now 2.9%. It's been that low since the pandemic, but at the same time, it's a very low number considering that 20-year average is 5.85. So it indicates that people are becoming more strapped, that they've spent down the savings. Again, depends on, this is an aggregate. Some people are definitely worse off. One area that we've seen this, if we go to the next slide, buy now, pay later. There are a lot more of these type of financing schemes that aren't covered in the prior numbers because they're not issued by banks. The chart on the left is sort of saying what percentage of people were, the number of 6% of the people were spending $5,000 or more on these type of plans. But you see, most of it is sort of in that $100 to $500 range at 31, and half of it's in that range between $100 and $1,000. So again, these are people tend to be in the lower economic strata that don't have a lot of money, that are having to turn to these kind of vehicles to finance their continued spending. And the impacts you see on the right is that people are spending more than they can afford, that in a sense, they're becoming more economically constrained, which will impact spending overall. If we go to the next slide, retail sales rebounded. What we've seen is that retail sales for the month of June went up by 1%, which was actually an increase, but some of this was also related to timing. There had been a cyber attack that impacted a lot of car dealerships, which constrained their sales in the prior month. So in this month, we saw a rebound in that. But so it's somewhat favorable, but you see that a lot of it for the month was driven by that increase in motor vehicles and parts. But there is more focus on spending it more on essentials, that you see sporting goods, hobby and books, and miscellaneous store retailers. Those sales are off. One area of the economy that may be looking better, if we go to the next slide, is mortgage applications index. So these are various aspects of the residential market. And what we had seen for most of this time is that high interest rates had kept the mortgage rates high. So a year ago, the 30-year mortgage rate was 7.56. What's nice is it's come down to 6.63. New home sales actually increased in July by 10.6% on a month-over-month basis, and 5.6% year over year. The chart under existing home sales still what constraints. They were up in July, but they're still down from a year over year. So this may be one area of the economy, while other aspects are being more constrained and maybe slowing down, may rebound as interest rates go down. On the next slide, if we look at the economy on the market manufacturing services index, it's important to note that these are measures of relative activity. So 50, the 50 line is where it means the dividing line between contraction and expansion. So what we see is that manufacturing still under 50 remains constrained. We are seeing that the services sector, which is on a total basis is actually more of the economy, continues to expand. So that's generally favorable. That we go to the next slide, business optimism index, that we are seeing the small business optimism index increasing. Again, it's still from relatively low levels, but it is improving, which is favorable. The charts on the right that we see inflation coming down as a concern, sort of matching what we were seeing with the consumer, that's not becoming as much of a concern on a going forward basis. And again, you look at the chart on the right, that the percentage of people expected to increase prices in the next 3 months and expected to increase wages remains lower than where they were 2 years ago. So what does that mean for interest rates in the investment environment? So if we go to the Treasury yield curve on the last slide, what we've seen is the dotted line was showing where rates were in June, which is sort of in the 12-month range that we were. The solid blue line was where that was as of July 31st. If I were to bring these forward, given the market's expectations for significant rate cuts, that 2-year rate, which had ended the mid-year or the end of the fiscal year at 471, ended July at 406, and now is at 359. So the market is expecting right now that we will see probably a 1% in total cuts during 2024 with additional cuts next year. That in fact, that the market's sort of expecting based on expectations today, that we would see a Fed funds rate of around 2.5, 2.6% at the end of 2025 versus about the 5.3% range that we're seeing right now. So the market is expecting that conditions will drive the Fed to cut rates aggressively. It will be very interesting to see what comes out of the Fed meeting next week when they release their expectations and forecast that will suggest what they think the Fed funds rate should be over the next few years and what they see as the economy growing. And what we've tended to see over the past couple of years is the market tends to lead the Fed by a wide margin, that the market tends to think things are much worse than where the Fed is. But we'll have to see what they have to say when they come at that meeting. But I think fundamentally what we're seeing is a changed investment environment with rates definitely coming down. We do see a softening economy, certainly at this point, not a recession. I think most mainstream economists or the consensus would be that we're more likely to see no recession, a slowdown, or possibly a soft landing. The things in the back of my mind that increased concerns are, one, geopolitical. We still have issues in the Middle East. The Ukraine war doesn't seem to be resolving itself. Those could be big issues. And just domestically, we have a volatile political environment now that could create, unexpected conditions that could drive the economy away from its baseline trend. So that concludes my presentation, unless there are any questions.
Thank you, Richard. Committee members, any questions for Richard? Jill has none. Richard? Do you have any questions for Richard Dixon? Veronica, any questions for Mr. Babb?
No, I just always enjoy his presentations. Just so helpful in many ways. Thank you.
Great. I see Maricella's on. Is Mayor Salachi on? Maybe not. Richard, my only question was, I asked you in June, your crystal ball. You thought they might lower rates. We all did, but they didn't. What is your predictions for next week's Fed meeting?
It was interesting. We had a survey among us when we have our morning call among the company. And the consensus there of our company was of not the company, but of our relationship managers, that the Fed would cut about 25 basis points. I'm tending to lean more at the 50 basis point level. I think I'll be proven wrong, but I just think they need to make more of a significant statement in the sense to say that maybe indicating they've waited a little too long to cut rates, that maybe they could have done that earlier. But I think the Fed tends to be cautious and wants to cut, will definitely cut. But the question is, I think they may think 25, I'm thinking more 50. So how's that to hedge my bets?
On that note, what's your feelings regarding interest rates? Once the Fed cuts, which I agree with you, they'll cut, not sure which number, when does that start to affect mortgage rates, and then maybe our investment rates? As maybe here Sujat is really, I think, really looking that they're going to cut rates and trying to invest as soon as possible. So
what you've seen is the rates have already come down. So like I say, is the 2-year right now, when I looked at before this meeting, it's at 359. It was at 471 at the June 30th meeting. So the market has already embedded what they think the Fed's going to do in interest rates. What we'll see is if the Fed said, and I don't expect this to happen, the Fed said, we don't need any cuts, or they said, hey, we're only going to cut by 25%. We only think one additional cut is necessary for this year, which would be not what I'm thinking, but would be much less significant than what the Fed's thinking. We would see interest rates rebound a little bit. So rates are going to continue to go down, but longer term rates, basically 2 years and out, have already embedded the market's expectations for interest rates. One thing that I think could be favorable for the agency is the fact that for most of this time, interest rates were high and that the pool rate offered by LA County was lagging current interest rates. But now we're sort of at the part of the yield interest rate environment where interest rates are starting to come down. So I looked on the report, and the earnings rate for the month for the pool was 4.19%. Yes, that will start coming down, but it will take time to do that. So you could actually see the pool offer a better rate in general than a lot of interest rates that you can get on individual securities. So that's sort of the outlook on interest rates.
And the one question is, let's say people looking to buy a home or a mortgage loans, how long does it take for that or has it already started coming down? You've indicated
it's already done that in the sense that I don't have it in writing. I can get that in just a second. In the sense that interest rates a year ago for mortgages, I think the number was 7.56, if I remember correctly. Yeah, the 30-year mortgage a year ago was 7.56. The 30-year mortgage today is 6.63%. So almost 1% lower than it was a year ago. What the 30-year mortgage sort of keys off on what the 10-year treasury is. So if the Fed statement and action sort of align with what the markets think, we'll see that 10-year rate continue to come down gradually over time as the Fed acts, and mortgage rates will come down. The thing that I would say is no one is expecting at this point in time, absent some significant development, that the Fed funds rate is going to go back to zero again. So what you're going to see is you may see the mortgage rate come down 1 or 2%, but you're not going to come down 5% in that. So I think that's one of the areas of the economy which actually will improve over coming months, while other parts of the economy may be slowing down.
Thank you. Get any more questions from our committee members? Seeing no hands, is there any public comment? None online, none in the auditorium. Great work. We'll move on to other matters. Committee members, any other matters to bring up? Jill? Thank you. Richard Dixon? Richard, you're on mute. Maybe you have none. So no other business. We'll move on to public comment period. You've got 3 minutes. Is there anybody online who'd like to comment on the items on the agenda or other items under our jurisdiction?
No hands raised online.
And nobody in the auditorium? Thank you. Great. And our next meeting is set for Friday, December 13th, 2024. I want to thank everybody for getting up early and attending on this beautiful Friday the 13th, and have a great weekend. We are adjourned.
Thank you, everybody. Take care.